I think we'll probably see continued strength. Obviously, it's something we want to watch closely, but revenue more than doubled year over year, so it's actually accelerating. And the company is very closely watching traffic in the stores, app store downloads, and so forth. And apparently, at this point, they don't see any reason to be concerned. And as you mentioned, Cook also said that he thought maybe the reaction to China was a little bit overdone, at least relative to Apple. China's over half the company's growth. It's absolutely crucial, and we expect the company's going to continue to do well, at least for the next few quarters.
The absolute numbers are staggering. You have a $230 billion company that grew almost 40% at constant currency. Top line grew EPS at 44% and has generated $80 billion in free cash over the last 4 quarters. All of those are otherworldly numbers. But Apple continues to be really sentiment-driven in terms of how the stock trades.
There's 2 exposures here. Number one is the US consumer, which we believe is on the cusp of another surge. The second is housing. If we look at some of the numbers coming out from housing, MBA purchase applications, so applications for new home loans, that's starting to bounce as well in a very strong way. That has a natural feed through into housing starts as well. So along with that US consumer story, we are seeing that house prices aren't expensive by really any stretch. Borrowing costs are very low, so that consumption very nicely fits into housing. And we do believe that you are going to see quite a good growth picture come out from housing cyclically, but also from a secular perspective when we look at the demographic.
There's a price to pay for 6 years of zero interest rate policy. I mean, it doesn't come for free. There's a lot of side effects. About $56 trillion of debt have been issued, $56 trillion since 2008, and a lot of debt's been issued in the commodity space. So this is creating systemic risk. We have an index of our systemic risk indicators that we track at SocGen. This is creating systemic risk. But if you look back over the last 20, 30 years, the Fed has never raised rates during a significant, profound decline in commodity prices. In the 80s and 90s, the U.S. was 65% of global GDP. Today, we're 25% of global GDP. So Fed policy has been dictated over the last 2-3 years. A lot of punches that the Fed has taken in terms of their credibility have come from outside the U.S.